While most of the world is focused on COP26 this week, the financial world is plugged into Central Bank Week, as some major CBs are getting on the road to policy tightening. The first mover came today in Australia, with the RBA making their latest moves. But what did they announce and how did the markets react? And is the situation with Italy making life tougher for the ECB? We'll be covering it all in today's Market Movers Daily. Hey, I'm Nicholas Puri, welcome to the video. We're on a really heavy schedule this week with major market moving releases, and while most people are focused on the Bank of England and the US Federal Reserve, the Reserve Bank of Australia was not one to ignore. In fact, as Jim Reed of Deutsche Bank wrote earlier in the week, I'm going to open the market section this morning with a line I don't think I've written in 27 years of market commentary and probably won't again. And it's not about England thrashing Australia at cricket on Saturday. Yes, the most important event of the week could be the RBA meeting tomorrow. So what did Philip Lowe announce earlier today? Let's take a look at their initial statement. The 3 points at the top summarise what was announced. They're maintaining the cash rate target at 10 basis points, continuing their government securities purchases at $4 billion a week until at least mid-February next year, and they're stopping the target of 10 basis points for the April 2024 Australian government bond. So this means the RBA is getting rid of its policy of yield curve control, meaning it's doing what we're expecting most major central banks to do and tightening its policy. On that topic, their statement said, "The decision to discontinue the yield target reflects the improvement in the economy and the earlier than expected progress towards the inflation target. Given that other market interest rates have moved in response to the increased likelihood of higher inflation and lower unemployment, the effectiveness of the yield target in holding down the general structure of interest rates in Australia has diminished." But it's fair to say that not everyone is buying into that narrative, and some critics just think this is a case of the RBA losing control. Last week, Australia's 3-year yields shot up by 8 times the target rate, and the RBA didn't take action. So as Jim Bianco says, this is how yield curve control ends. It blows up in the central banker's face, and then they go to great pains to explain that this was really all part of the plan. And let's not even get started on how their actions so far have impacted the property market. We'll save that one for another day, eh? But while the bond market has seen a lot of volatility, the Aussie dollar has been fairly tame in comparison. Of course, we've seen a reaction today to the announcement that came earlier, a bearish move that not everyone was expecting, but it's still staying relatively range bound. And that's really the story of many currencies this week. Trading is pretty much stuck in ranges, which I personally think is a pretty good thing at the moment, because ideally you'd want to trade very short-term moves at the moment because we've got these different big events coming up throughout the week. So if you're range trading, that means that you've got a chance to have a short-term move in and out in a very, very dependable way, and then you don't have to be holding on throughout these big events that may disrupt things. So does this mean we're starting to see the peak of that longer-term wave? Can we expect a further move down? Let me know in the comments what you think is going to happen with the Aussie dollar. Are you trading it? If not, what markets are you trading? Let me know your thoughts down below. WTI Oil has also been struggling around its recent high, and it seems it may be breaking bullish structure. So we broke the bullish trend line you can see a little while ago, and that gave us the earliest indication that a shift was happening. This has then been followed by lower highs, which means that we could start seeing some short-term bearish structure begin to take hold. And of course, we have got OPEC coming up again, which actually seems to be overshadowed by all of the central bank news this week. And speaking of central banks, again, I'm also keeping an eye on what's happening with Italian bonds. The spread between Italian and German 10-year yields, which is seen as a gauge of the risk of holding Italian bonds, shot up to its highest level in a year. Since Lagarde has said that pandemic bond buying, their bond buying program, the PEP, will end in March, it's now had a knock-on effect on the confidence in some of the riskier bonds such as Italy, Spain, Portugal and Greece. And we know that the ECB will be keeping an eye on the situation because Italian spreads are one of the key indicators of financing conditions. So if selling accelerates, they'll have to step in. And the PEP has got flexibility to increase purchases to stop financial conditions tightening. So to end on a light-hearted note, the situation for the ECB in a nutshell, from a meme that I saw on Twitter, that one really tickled me earlier. So let me know what's on your radar in the comments. Feel free to share your memes with us. You can find social media in the description box. Hit the like button if you like these Market Movers daily videos, and I will see you tomorrow. Take care.